First off, are you impressed with the index action in light of last night?
Yeah, it looks like, small caps are doing okay, right? And I think some of the earnings were pretty good. Like, if you pick through, obviously big cap tech had its issues, which I'm a little surprised the market didn't anticipate some of the currency stuff and other things. But, there's some pretty good numbers. Wingstop. I mean, there's some things you could pick through that are pretty good.
Oh, your Wingstop's
people like
outweigh
wings.
Microsoft?
People
really?
like wings. People like wings. I don't like them. But, I'm looking at the market. I just came back from a dozen meetings in Boston in the last couple of days. And I think there's two big debates people are having. One is, which of these cyclicals that are out there are so cheap that even if the numbers are 30% too high, they're okay? Is it home builders? I still like energy and metals, but some of these metals trade at 2 times earnings. So even if the earnings are 40, 50% too high, it's okay. So there's a lot of debate about that. And the second thing, a note we wrote last Friday, let's pretend it's October 19 and we're looking ahead a few months, and then here we are, October 22, looking ahead a few months. Even if the forecasts for next year are 15, 20% too high, are there any businesses that are just going to have so better fundamentals by a mile? Is it Amazon, which revenue will be twice as much in 23 as 19, even if the numbers are too high, where you can find ideas. And so we've been going through a lot of those sort of maybe oversold growth that even in a slowing economy can still be okay. And I think those are the two areas that I find in my meetings people are looking for the most long.
Is Amazon one of them?
We had a governor on our list that included it had to be less than 25 times forward earnings, so to try to rein it in a little, and that one still doesn't have it. But as you know, they could flash some profit margin a little bit, and the stock will be a rocket ship. So it's probably one that I'd say most people are looking at as sort of the large cap one they have the most confidence in, and I assume with the results from the big names last night, people feel better about it relatively.
Right.
Yeah.
How about, Bank of Canada, we just mentioned, hikes 50, less than expected. Australia did the same not too long ago. Are they beginning to blink around the world?
Yeah, I mean, clearly the big debate is, is it just an all-clear signal if they get dovish? Is it just that simple and we're going to go back to 20, 22 times earnings and everything's fine? Or, does it happen? It's funny. This morning I was thinking to myself, we're back to bad news is good. We get some bad economic news, right? A little bit lower consumer confidence, a little bit, that all of a sudden bad is good. That's what we need because then we'll get dovish and it's off to the races. But the other side of that equation is, you're multiplying a higher price earnings ratio by lower earnings at some point, right? And so I think, is it just that easy? Sure, you can get a quick, 5-7% move in the market, but I think you're sitting here today, you sure up 10 is higher probability than down 10 from here? I'm not so sure. I think it's kind of balanced, and obviously for the first time in my life, we've been buying the 2-year yield because that looks better than utilities and looks better than staples, and so it's not as obvious to me the multiple can just run to the hills just because we get a little bit of weaker.
Yeah, no, listen, you're embracing a lot of the conversations that take place everywhere, including ones I've had, which is, we're 220 for S&P earnings next year. Should we be at 210 or are we moving down to 200?
You know what I've been thinking a lot the last month or two, we started writing about it in August. Maybe maybe what we're wrong about, or the street's wrong about, is maybe it's just going to be a little bit less than people think, but then again, it's lower in 24 than 23.
Yeah, you mentioned this the last time you were on as well.
I'm starting to get more conviction in that.
Well, that's not good.
No. It isn't. It isn't good.
If next year we're going to be sitting here talking about...
So the two things, you go back to what I said before, it's either such a cheap cyclical that it's okay in that slow erosion scenario, or it's Visa, which is going to have much steadier fundamental, or something that can just power through and still have positive growth, even in a slow decline. I think that's where you have to make your bets, because I'm not saying it's the base case that 24 is below 23, but I think it's a lot higher probability.
Why is that, though? Why?
Because what we've none of us have ever had in our lives so far is this nominal GDP this high. And I don't see things collapsing. I just see them slowly, auto loans are getting a little squishy, a little bit of 90-day delinquencies picking up. But we don't see a collapse, right? We just have a little bit of production caught up to consumption, so some of the businesses have excess inventory. But I don't see blinking reds of this is a disaster. I think it's more just we're going to slowly decline. The Fed did slow down the economy some. We had all that fiscal stimulus, which is picked through the snake a little bit. And so maybe we're just going to slowly erode. And I don't know, 235 is the number for 2023 consensus bottom up. Maybe it's 220 and then maybe it's 215 and 24. Or maybe it's kind of bathtub shaped. And I think we were all used to a V shape because we're it collapsed, the Fed comes in, fiscal in, and boom. I want to almost buy it before the bad news comes because it's going to recover again. And now it's well, maybe it's slow and steady down, and therefore I've got to find stuff that's already discounting it.